UK GDP growth is set for its worst year since 2009. That's according to the British Chambers of Commerce, which has downgraded its UK forecasts for this year and next. Joining me now is the co-author of the new report, Suren Thiru, Head of Economics at the BCC. Suren, thanks so much for coming in. So you're expecting 1.3% growth this year, 1.5% next year, and this year would be the worst growth since the financial crisis. So presumably you think Q1 wasn't just a blip.
Yes, so Q1 was quite a weak start to the year, but what we're seeing in our own forecast is a broad-based weakening for the rest of the year. So we may get a pick-up in the second quarter, but a bounce back from the weather impact in the first quarter. What we're seeing is a weak outlook for consumer spending, investment and trade. So it's key parts of the economy doing slightly worse than we expected in our previous forecast.
So I think one of the most alarming parts of the report for me was your view on the service sector, which obviously accounts for the lion's share of our economy, dropping to the lowest level since 2010.
Yes, well, a lot of focus has been on the issues around construction and manufacturing. You're quite right. The UK economy is essentially a service sector economy. And what we're seeing, if you break it down a little further, is actually there's a split between businesses that do business with other businesses and businesses that are consumer focused, retail, hospitality. Now, those business firms are doing really well, but those consumer-focused firms like hospitality, like retailers we're seeing on the high street, are struggling quite a bit. And part of the reason behind that is the weakening sterling, so impacting consumer spending by rising inflation and squeezing earnings. I think that's a real trend we're going to see over the next couple of years at least.
Yeah, of course, and we've seen that with sort of the demise of the high street recently. But is this designed to be then a kind of a wake-up call for the government?
Yeah, absolutely. I mean, what we're seeing in our forecast, this is based on what we see in the moment, but of course things can change. What's really underlying the below average growth we're seeing in the next couple of years? Of course, Brexit uncertainty is part of the reason, and the impact of weaker sterling. But actually what's underlying the below average growth has been the failure to deal with some of those long-standing issues, so weak productivity, the imbalances in our economy, the over-reliance on consumer spending and services to drive growth. Now, if we deal with some of these long-standing issues, then the growth picture could look a lot better.
So how should the government be going about trying to fix this productivity issue?
Well, it's about looking at the nuts and bolts of any economy. So it's dealing with those sort of fundamental issues. There's a huge skills gap in the UK, right across the economy and across different sectors. That needs to be addressed. And that's obviously looking at skills at home, but also developing a migration system over the long term that better fits the needs of our economy. It's also looking at our infrastructure that's digital and physical. So looking at sort of boring things like the local road network, potholes, and that sort of thing, and good broadband. Tackling those sort of basic things for any economy will help businesses grow better, grow more, recruit more, and invest more.
So I wanted to ask you about wages, because you believe that real wage growth it has turned positive, but you see that positivity continuing. So we're seeing strength in the labour market, but that's not really translating into economic growth. Why is that mechanism not necessarily working?
Well, the wage story is quite an interesting story, because you're right, while we're seeing record low unemployment, wage growth has been fairly sluggish for almost a decade now. And there's a couple of reasons for that. Obviously, weak productivity is the big underlying factor, but what we're also seeing is a lot of costs being placed on businesses. So a lot of costs for businesses at the front end. So we've seen the business rates being a huge burden for businesses, the introduction of the apprenticeship levy, all these sort of upfront costs are hurting businesses right at the front end. So that's constraining wage growth. But what we will see in the next couple of years is wage growth pick up slightly. But what we think is going to happen is that because inflation is going to, fairly stubborn on its way back to Bank of England's 2% target, actually the impact on consumer spending is going to be quite limited. And also at the same time, you're seeing household finances being pretty stretched from both high household debt, but also a low savings ratio as well, which means that what we're going to see is a lot of households rebuilding their balance sheets over the next year or so.
So I wanted to ask you about the Bank of England this week, because I spoke to a former MPC member, Andrew Sentence, earlier today, who said that the bank should be raising rates more quickly than they currently are. But you say that the economy is in a torpor partly because of rising rates, so presumably you're more on the dovish side.
Well, certainly, rates at the moment, I mean, our view is that during a period of both economic and political uncertainty, what the Bank of England should be doing is actually providing monetary stability. So, giving a clear path forward for interest rates. Because at the moment we're seeing an economy weakening, but we're seeing inflation coming down as well. So the case for cutting rates, for increasing rates, as I say, is really limited at the moment.
So do you think the bank's not being clear enough?
Well, they're certainly sending out mixed messages, and I think that's a clear issue for both businesses and consumers. Now, a rate increase won't have that big an impact financially, particularly on the majority of businesses, but our concern is that the impact on business confidence, because hearing certainly over interest rates at a time when there's also concern around Brexit and the wider economy.
Is there any argument for kind of creating a monetary buffer in case we do end up finding ourselves in a recessionary situation?
Well, actually, what businesses are saying, they actually want stability. That's the key thing. They want a bit of a certainty, because there's a lot of uncertainty out there. What need their central bank to do is actually provide stability and certainty. So actually keeping rates on hold for a prolonged period that will actually help maintain business confidence.
So when you speak to businesses about Brexit, what are the type of questions that you're getting asked? What are the key concerns? Or are some businesses excited about the prospect of kind of going it alone?
Well, businesses are certainly looking at the opportunities, absolutely. But I think the challenges are really around those practical level questions. For example, how long is it, if I'm a business, I trade with Germany, how long is it going to take for my goods to get out of customs? Who do I pay VAT to post-Brexit? It's more those sort of practical level questions that businesses are looking for answers to, and are not really getting it at the moment.
And so what kind of advice are you giving businesses around Brexit?
Well, one of the things businesses can do is do a bit of a Brexit audit. So look at their own supply chains, look at who their suppliers are, look at their workforce, and actually, if the business are looking at their own business and carry out a real sort of thorough audit, that could leave them in a good place, post-Brexit, take advantage of any opportunities that are out there.
And I wanted to ask you about the prospect of a trade war and how significant a risk you think this is, because you pointed to it in your report. Obviously, we're seeing increased global protectionism. It's being discussed a lot. How worried are you about that?
It's certainly a concern. Now, what's been announced already will have a limited impact on the economy, given the size of trade, the UK's trade with the US. But looking forward, if it becomes more broader and more widespread, that's clearly a concern for UK exporters and also business investment as well, because I think that will not have quite a big impact on confidence as well. The outlook for UK exporters is weakening a little bit, as you see with our forecast. You see growth in key markets like the euro area and also the US moderating a little bit. That trend's going to continue over the next year or so. So that's going to have an impact on UK exporters. What we're also seeing is that the impact of the weaker sterling has not really had the positive impact, a net impact on exports and our trade position overall, because a lot of exporters also import at the same time, so on both sides of the fence. So actually their costs are going up, although the front-end products are more cheap, more cost-effective. And
also a lot of that depreciation has reversed now.
Absolutely, yeah. So I think we're very much past the sweet spot for UK exporters, and UK trade's contribution to overall UK economic growth is going to be quite limited over the next couple of years.
Okay, Suren, thanks so much for your time. That was Suren Thiru, Head of Economics at the BCC. Thanks so much for joining us. I'm Victoria Scholar, and we'll see you soon.
Subscribe to IG for educational content, company insight, financial analysis and expert commentary.